Friday the 6th of October. Stocks are higher, and they're not convincingly higher, but they are higher. And given the blowout payroll number, I find that in some ways a little bit surprising. This is a very strong economy in the United States, which in theory should move to higher yield, which should in theory be bad for stocks. Doesn't feel like it's working out that way. Yes, we're down on the week. Maybe that's what we should be talking about. Anyway, that's the picture. Countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Okay, look at this board and tell me if we just got a massive, almighty blowout payroll number. Because you look at these numbers and you're thinking, nah, end of the week, nothing really to see here. We can move along until next week. We just got a huge, huge print out of the United States. This is a big piece of data, and it was massive. And the market in so many ways has shrugged its shoulders. Maybe we've already had the move. That's what we're seeing here. Maybe we're going into the weekend. Maybe we're thinking about the CPI data next week. But the stock 600 is up by 0.5%. We're trading 443. The pound is barely budging, 121.89 against the dollar. German yields are a little higher, but we've been north of 3 this week. We're not there yet. We're at 2.909. So you look at this board, and I don't see, Alex, a big blowout payroll number. But that's what we got.
I mean, same deal here in the U.S. with the exception of the bond market. So just look at this one. 10-year yield up 9 basis points. The 30-year made a run for 5%. All of that feels very dramatic. But then nothing else at the same time. Like in the middle of the week, the S&P, we were talking about the 200-day moving average. I mean, like 26 points away from that. We are well off that level now. We're just down by 0.1%. Now, part of the reason why that index is actually doing well is Pioneer Natural Resources. The stock is up 10%, the best performing stock within the S&P. That's on takeover rumors between Exxon and Pioneer. Now, even the Bloomberg Dollar Index, we got an initial pop higher for the Bloomberg Dollar Index, dollar yen again making a run for 150, and then we kind of paired some of that. Now the currency is a little bit mixed, just up 0.2%, Guy.
Yeah, but it's not. This was the number we've been waiting for a week. This was going to be the huge moment. And I'm not entirely convinced that the market is taking it that way, which is a little disappointing on a Friday. We were expecting kind of fireworks this afternoon. We're not in some ways getting them. We are, after all, in the volatility business. German 10-year, here you go. Here's the 5-day. Wednesday, we get to 3%. We go through 3%. We fade that pretty quickly. And as you can see, we have seen that's the pickup there on the payroll number. That's Wednesday. Now, there's all kinds of other things going on earlier in the week, but that's the pickup off what I can only say was a massive move on the data that we've seen, Alex. But maybe the market's already kind of through that and is already thinking that it's priced this. I don't know. I'm a little confused.
Yep. I don't know either. And that's why we're not the experts. Good sign. Sophia Drosos is .72 economist and strategist. We talked to her earlier about the hot payrolls number and what it means for the Fed and what it means for growth.
Inflation is starting to make a lot more downward progress. And I think another important aspect from the jobs report today is that we're seeing wages moderate, and we're also seeing supply come back into the labor market. So it will give the Fed an opportunity maybe to stay on the sidelines and see how things develop.
Yeah. Wait, watch, see what happens. But at the moment, this is an economy that feels like it's riding pretty high. She's just upgraded her third quarter GDP forecast really quite significantly, Sophia. Fourth quarter, yeah, we're going to hit a bit of a speed bump, but maybe we get through that. Maybe we don't get a significant recession. And that takes us to our question of the day. What landing? Joining us now to discuss, Eddie van der Volt from our MLive team, Ira Jersey of Bloomberg Intelligence. Eddie, you're standing next to me. What landing?
Well, I have to say, to me, this is what a soft landing looks like, right?
Okay.
This is what we're seeing here, what we got from the jobs number, first of all. We got a hot reading saying, you know, the economy is growing strong. At the same time, you've got inflation coming off, wage inflation coming off a little bit. And you've still got some room in the participation rate for more workers coming back. Therefore, what do you see? You see yields having to build in a steeper yield curve via the back end. You see bears steepening, and you see the stock market saying, well, we can cope with that because the economy is strong. People are going to keep buying, people are in jobs. To me, this is the perfect reaction. I think the initial reaction was what you would expect: hot reading, high inflation, maybe, or a Fed that's going to hike, and therefore you see the equity market pull back. But I think people are looking at it now and saying, no, this is actually really exactly what the Fed is aiming for.
Hey, Ira, I mean, the bond market's still selling off. Do you agree with what Eddie was just saying?
Yeah, Alex, we've talked about this. You know, if the Federal Reserve doesn't cut interest rates in 2024, which is actually our base case scenario here at the Bloomberg Intelligence Rates team, then the bond market needs to be much flatter. And in particular, what is the interesting trade to me that's not happening is that you don't really see the 5-year sector selling off more than the rest of the curve, because that's really the adjustment that has to take place if the Fed's on hold for even longer than we think, which, you keep on getting data like this, and you have to keep on pushing out when you think the Fed might actually have to cut rates. And that's no time soon, at least based on this data.
It was interesting, actually. I think the kind of the biggest moves initially did come in the 5-year, but as you say, that has since subsequently, that move has retreated. Are we at the point where the Fed and the market are now aligned? Have rates come up far enough to kind of align themselves with what the Fed is thinking? And if rates go further from here, do you think the Fed will be worried?
Well, I think we were at what the Fed was thinking if you just take the dot plot as gospel, which of course you can't. But if it were, then 10-year yields should be probably about 40 basis points lower. So basically, where we were 2 weeks ago is about fair value based on what the Fed thought. So the market's basically saying that, hey, the Fed's going to have to shift their opinion, in particular because the data has been much stronger than just about everyone has suspected. I mean, you look at the jobs numbers today. You guys have pointed this out on Bloomberg TV all morning that it's almost 100,000 above even the most optimistic estimate, right? So I think as the economy changes, the market is going to instantaneously shift what it thinks the Fed's ultimately going to do.
Eddie, Citi overnight, before the number, upgraded their call on global stocks to a buy, saying like, look, we have balanced macroeconomic risks, like buying dips, like cyclicals. Does this data make sense to you with that call?
Look, I think so. I think unless you are seeing some sort of major correction brought on by a higher yields, which triggers then, which triggers an event in which the Fed has to cut, which is then a bull steepening and a very different scenario. And that's the sort of steepening that markets are used to trading. So it's not a surprise that people are pivoting that way. But, in this environment, as long as the economy remains strong, then it makes sense. Why not go for the Nasdaq? Why not go for the speculative stocks? I will say though that we're inverted on the 2s, 10s by about 27 basis points at the moment, right? The next 27 seems easy. It's what comes after that. Yeah. How much of curve uninversion do we get beyond that? Because it could be significant, and if that goes much further, that could start to, I think not a lot of people know just how much higher 10-year yields have to go.
And over here in Europe, we're looking at this, scratching our heads, wondering what's going to happen next. The Fed in the past has had to react to global events. It is theoretically the central bank of the United States, but in the past, events have come in and force the Fed to react from outside of the United States. Are we setting ourselves up for that scenario again? We're sitting here in Europe. The economic data is not very good. Many parts of the emerging markets are already seeing cuts coming through, yet yields are going higher. We talked about this earlier. They are their yields over there in the United States, but is it our problem? And is that where the problem is going to start? And then
exported back to the US and, the circular. It's possible, right? The PMIs in Europe still look like a stagflationary economy, right? It looks like the PMI numbers are still very, very weak. It shows that there isn't growth, but they do appear to be bottoming out.
But that was before this kind of that's before this kind of big rise in the cost of capital came through once again, exported by the United States.
Yeah, and it is a problem for Europe, and I think that will remain a problem for Europe. I think the US is fairly immune to contagion risk unless there's some sort of banking crisis again, right? And we had that earlier in the year, but I don't see that with higher, steeper yield curves. I just don't think that's a problem for the banks.
Hey, Ira, game this out for me on the short term. What if we get a hot CPI on Friday? What happens?
Yeah, then I do think that we could have even more of a flat yield curve. So I do think that there's a limit. Just talking about the curve discussion a little bit, I think there's a limit to how steep the curve can get in a bear market. So with 5.1% is more or less the yield on the 2-year note. If the Fed is on hold for the next 18 months, then it's going to be difficult for 10-year yields probably to get above that level. So you could have a pancaked yield curve, but eventually the next big steepening in the curve probably has to come more from a significant bull steepening. So 2-year yields being much lower in anticipation that the Fed's going to cut. But a hot CPI number, we can get to a pancaked yield curve in a hurry. That could be one trade right after we get a pretty hot, like a 0.4, 0.5 on CPI next week.
Yeah. Very gappy markets, as you say, you could move very quickly to that. And as you've said to me already this week, then you maybe stabilize. Ira, what's the relationship with oil going to look like over the next few weeks? Oil has come down really sharply this week, and I'm wondering if that sticks and persists, what impact that's going to have back into bonds.
Well, it has some effect because of the expectation, again, of inflation and how it affects inflation expectations. But keep in mind, most of this move, in fact, all of this move, has not come from the inflation expectation side of the rates markets. Yep. It's really come from real yields going up, people thinking the economy is going to be a little bit hotter. That means that things like R-star that we always talk about is probably even a little bit higher than we had suspected it was just a few weeks ago. So it's really the real yield move here that is quite dramatic. And we're talking about 5-year real yields potentially hitting 3%, which we have not seen since it's been almost 20 years since we've seen that type of level on short-term real yields.
Yeah, it's such a good point. We keep forgetting that it's not inflation break-evens that are moving it higher. Hey, Ira, thank you so much. Ira Jersey of Bloomberg Intelligence, and Eddie Vandervalt, always a pleasure to see you as well from our MLive team. Coming up, we're going to get more insight into the question of the day, what landing? Jerry Fowler, UBS head of European Equity Strategy, joins us next. This is Bloomberg.
I think we're still likely to see a mild recession at some point next year, probably going into mid-year, maybe first half. And I think that because we are going to see the Fed, as it's been trying to get the market to believe for a year, now they finally believe it, they're going to have to hold rates higher for longer. And so this tightening pressure is going to remain and feed through to the economy, consumers and businesses.
Fantastic. Rebecca Patterson, Bridgewater's former chief investment strategist, speaking to Alex and I in the last hour, taking us back to our question of the day. After that payroll data, do we need to be asking what landing? Joining us now, Jerry Fowler, UBS head of European Equity Strategy. If you're a European equity strategist and you're looking at the United States and you're looking at the data that's coming out of the United States, how do you answer the question about kind of the US having no landing and the European economy maybe having a landing? How does that kind of manifest itself in your world, Jerry?
So there's definitely been some divergences. It's been a little bit of a surprise how weak the European economy has been, both in terms of the economic surprise through the second quarter, some of the retail sales data we've seen with the August data just coming out and surprising to the downside, but also just very much in the surveys, the PMIs, and we're not just talking about the headline PMI for manufacturing and services. The new orders are disastrous. And probably the most interesting thing at the moment is that the backlog of work, particularly in industrial sectors, seems to be deteriorating pretty rapidly in Europe. So it is surprising that Europe is looking remarkably weak in contrast to the, I wouldn't necessarily say acceleration in the US, but the resilience that we're seeing in the US. It's certainly a marked contrast.
Jerry, we were talking to Max Kettner of HSBC earlier in the week, and he was just saying, yeah, I get all the bad news, but that means that growth expectations are so low, earnings estimates are so low, that the bar to beat is really low. Does that hold any water for you?
Not really, because if we're talking about Europe, it does feel a lot like the expectations are actually still pretty inflated. I mean, you've still got earnings expectations and particularly margin expectations that are near record highs. And we've got a very good chart that looks at nominal GDP and its growth rate through time. And it's very clear that when you get decelerations in growth, and that applies whether it's a demand-driven weakness in growth, weakness, or whether it's disinflation, which is more the driver at the moment, in both cases, you get margin contraction. And so why we aren't seeing more analysts take an axe to their margin expectations is a bit of a surprise to me. And margins are going to be far more important in 2024 if they normalize versus what's happening to revenue. Very easy to have a soft landing in revenue, especially when you've still got elevated inflation. But it's also very easy if margins come down for that to still be a very hard landing in earnings. Our macro model would actually suggest that 2024 earnings for the European market are going to be minus 17% if we're right on our margin view.
Wow.
Okay, so walk me through what that's going to look like in the upcoming earnings season. How out of touch do you think most of the street is?
So it's all pretty imminent, I think, and we're starting to see it play out in that Q1 was a bit of a surprise in Europe. Lots of companies beating. About 80% of companies beat expectations because winter wasn't as bad. Q2 was roughly the same number of beats versus misses, and that was in an economy where economic surprise was significantly negative, but that was from inflated expectations. But all through Q3, the data in Europe has looked weak. And importantly, big sectors like the mining sector, the auto sector, and particularly the capital goods sector, are starting to report in their PMIs that they're running out of work. The new orders have been weak for a long time, and now they're reporting that their backlog of work is also weakening. And Alstom is a great example of this. You get a big share price reaction when a company comes out and says, we aren't doing as much work as we thought, our cash flows significantly deteriorated, and whack, the shares will get hit. I expect that in this season, we will see more of that from more of the cyclical sectors in Europe, just by the way they're reporting in their PMIs and what we've seen in some of the economic data that will really, not necessarily hurt their revenues to any great extent, but potentially be quite consequential for their pricing power and their margins.
Jerry, what gets hit the hardest? And I know you mentioned cyclicals and Alstom, and that's a great example, but are there other sectors that are going to get hit just as hard, or is it really this manufacturing cyclical story that worries you the most?
Yeah, it definitely still is. So if you look across the services sectors, they have been weakening, but nonetheless, they're weakening from a very high level, and they're starting to look like they're troughing at more normal levels. They don't look like they're continuing to decelerate and weaken dramatically down in the same way that manufacturing and goods have. But nonetheless, I think the broad market will suffer in various ways because there are three things we're worried about. One is yields. And so far, that's the dominant factor driving markets in Europe. In fact, pretty much all of European performance between sectors and stocks can be put down to the significant shift in the yield environment. That's really impacted valuations, probably hasn't impacted them enough yet. We actually think the European market is now 5 to 10% overvalued because it hasn't reacted enough to yields. But after yields, you then need to think about margins. So we've been talking about that. Obviously, cyclicals are going to be hurt most on that front. But then also, because we're getting more correlation between stocks, volatility is going to have a consequence as well. And high valuations don't like volatility. So things like consumer durables, the luxury sector that is, semiconductor equipment, some of these higher valuation sectors that are suffering from crowding as well as some earnings risks, still the most vulnerable to us alongside those industrial cyclicals in the capex space.
Jerry, I'm now looking for a place to hide. Given what you just told me, where is there such a place?
Well, I must admit, we didn't predict this yield move to be as dramatic and as quick as it's been. So we did think it was going to be defensives along the lines of utilities, cheap defensives that are just quite resilient both to volatility. That's been a very tough call this week, mainly because we were mostly focused on profits and volatility being the key drivers, but actually yield so far has been the dominant driver. But nonetheless, I think you need to look for defensive value. It's just that within defensive value, it's reasonably hard to also avoid duration. This yield sensitivity has been consequential. Now, we view yields as likely peaking at this point because we have a negative outlook for profits. We think that weakness in employment will follow. So we think we are heading into a fairly normal business cycle. And the yield move we've seen is actually more technical, relating to the Fed basically saying they're going to keep real yields higher for longer. A real technicality is that there's more risk premia in long-term bonds now. The term premia has risen, and that has consequences for equities and equity valuations that are reasonably permanent. But to some extent, if the move has happened, it could be a one-off. That term premium is now back to its 20-year average, so it could go higher. But at least we've washed out what has been a historically low level of term premium in interest rates.
Okay, Jerry, with a not very happy, optimistic short-term view on equities. Thanks for that. Jerry Fowler of UBS, thanks a lot. This is Bloomberg. All right, here's one story that I'm watching. Okay, you got Walmart. Shares are down the most in more than 7 weeks, guide. So yesterday, the company said Ozempic is hitting shopping demand, and you can see it reflected in Europe also. You got chocolate and booze manufacturers are saying that they're suffering. You got Danone, for example, Lindt, Anheuser-Busch, InBev, Unilever, that makes Ben & Jerry's ice cream. They're all sliding today as well. So we know the story, right? I mean, if you take this drug and it suppresses your appetite and your thirst for alcohol, but I don't know. Are we getting like way ahead of ourselves as to like the long-term impact of this?
I think maybe, but it's a fun exercise to work your way through what impact it could have. And in some ways, you look at Nestle today. Nestle under significant pressure. Nestle has been trying to move away from the unhealthy to the healthier stuff, so maybe it doesn't get hit quite as hard. But yeah, you could see a reaction in all of this. I guess the market is meant to be a forward discounting mechanism. Maybe it's meant to do exactly what it's doing right now and think about the impact that potentially all of this could have. But in some ways as well, this is a yield move. In some ways, this is an area where you would have thought you'd see some more sort of defensive strategies coming in and buying some of these stocks. But I think it's fascinating. Lindt & Sprüngli down as much as it is right now. That's high-end chocolate. If you're going to eat chocolate, maybe you want to eat high-end chocolate. That would be my strategy.
Well, also, we talk about it as like junk food is what's going to be cut. But, I mean, that might not be true. You're also just eating smaller portions in general. So it could hit sort of all the main players. But to your point, too, like, inflation's still high. That's still going to bite into the bottom line for these guys and the top line. So maybe that's there, too. I don't know.
Yeah. And in some ways, they're yield proxies. These are big cash-generative companies, and in some ways, therefore, they compete with the bond market. You've seen what's happening in the bond market.
Right.
But it's interesting as well. Maybe you eat better. Maybe you make more discerning choices. I don't know. I don't know how this is going to play out, but it's quite a fun exercise to work your way through it. Is that Lindt & Sprüngli?
No,
chocolate?
it's Nestle, but I still want it.
Is that Nestle?
Yeah.
Verve. Not Bahnhofstrasse. I can't remember where it is on Bahnhofstrasse in Zurich. Some very nice chocolate to be had. Quick look at European equities. We're coming into the close. Let's show you what is happening here as the camera follows me around. Here are some of those names. There's Remy. There's Nestle. These are 52-week lows that we're seeing. There's the utilities that Jerry Fowler was just mentioning. RVA down by 1.21%. There's Alstom that Jerry Fowler was just mentioning. That is the worst performing stock this week. I think it's down circa 40%. It's been a brutal week for European equities. We'll deal with the close next. This is Bloomberg. If you'd have told me 20 seconds after the payroll number dropped that we would see a positive equity market today, I may have questioned that. But that's what we're getting. It's fascinating to see how things have turned around quite so quickly. In some ways, you could argue a solid consumer in the United States bodes well for corporate stocks. And maybe that's what we're seeing ultimately being priced here. It's fascinating, though. We are still down on the week. Let's not kind of make bones about that. This is the picture we have today. But the week, let me show you the week. It's been a fairly bumpy ride. And actually, the losses came fairly early on. And we've been kind of bumping along the bottom since then. So this is the 5-day picture. We're down by around 1.2% on the stock 600. But as I say, the losses came early on. And since then, we've been kind of cruising sideways, waiting for the catalyst. I thought that may be today. I thought that may be the payroll number. It's proved not to be. Maybe it's the CPI number next week out of the United States. The yield story is interesting as well today. This has been a story this week of higher and higher yields being generated out of the United States and then exported to the rest of the world. You can see that in Germany, where we earlier on this week hit 3%, but we've backed off it. Today, we go up, but not that much. Similar story with gilts. 458. As you can see, yields higher, but not massively today. the moves came earlier on in the week. Euro dollar is now back to being positive. The dollar is down. We're at 105.90. We're up by 0.4%. Honestly, if you looked at this board and said, have we just had a blowout number in terms of the payroll number, I think you'd be maybe questioning that. Single stocks are fascinating again. Novo Nordisk is a continuing theme running through this market. Ozempic, these weight loss drugs, having a big effect on some big stocks. Nestle, 52-week low. That stock is down by 2.5%. You can see it across the packaged goods stocks. We've just been talking about it. The big loser this week, though, has been the utility sector, which has been absolutely smashed lower. But that's a more direct bond proxy. Kind of makes more sense in some ways. Novo Nordisk, though, up by 1.5%. Can they keep up with demand? What's pricing going to look like? So many questions surrounding that story. But the big loser this week, today it's down by 0.6%, has been Alstom. But Jerry Fowler was mentioning it from UBS. This is a industrial company out of Europe that has had to come through this week and kind of admit to the challenges that it is facing, and they are significant. And the stock has been brutalized by the market. Will others follow? Is that going to be the narrative coming out of this earnings season? Okay, that's this week. Let's talk about next week. The Labour Party conference is going to be absolutely fascinating. This is in some ways a government in waiting. If you look at the polls right now, the Labour Party looks like it could form the next government, but we're still a year out from the election. Are we actually going to see some details being added to the policy mix that we've been seeing unveiled? Next week as well, we're going to get some fascinating numbers. Tuesday, LVMH, sales and revenue. What is happening there? These are stocks that have been battered. Partly on the slowdown in the United States, partly now the slowdown in Europe, but of course the story out of China as well. German CPI, I think that's the final number, and then we're going to get some great coverage out of the IMF 2023 annual meeting. That picks up Wednesday, goes through to Friday. But Alex, from a UK perspective, I think getting some more detail, getting a bit of a greater sense of certainty surrounding the policy formulation that the Labour Party is going to push forward, if it were to become the next government, I think will be a really crucial moment for the UK and for international investors and their perspective of the UK.
Sure. I mean, it feels like we're inching towards a Labour Party government, right? So if that's the case, what does that mean? So going to look at the conference, I want to set the scene on this because this morning the Labour Party won by a by-election in Scotland, a large swing from the ruling Scottish National Party, a major boost for the opposition party that could be on track to win that next general election, which could be next year. Joining us now is Harry Quilter-Pinner, a Director of Research and Engagement at IPPR, a left-of-center think tank. All right, Harry, I'm sitting here in the middle of New York City. I'm obsessed with politics here in the U.S. Tell me what I should care about next week at the Labour Party conference.
Well, I think you're right to say that the Labour Party will be going into the conference in a buoyant mood. They are well ahead in the polls. As you say, they've just won this seat back in Scotland, which is a real sign that they could get a majority. It's very hard to get a majority without Scotland. And so they're going to feel very optimistic. But I think there's still quite a big challenge facing them. I think the country are definitely fed up with the government. I think there's a mood for change, but I think the electorate are yet to fall in love with the Labour Party. So I think there's a lot of work to do to set out a vision that really excites people and shows that there's a more positive future.
Harry, when does that moment come? We're a year out potentially from an election. Is it still too early for the Labour Party to start detailing policy that the rest of the world wants to know about, but maybe it's a little too early to start kind of laying out? Because the Conservative Party's got a recent history of picking up on some of those policies and making them theirs.
Yeah, so I think what you'll see is the Labour Party being quite risk-averse, quite concerned about putting out policy detail that, as you say, they might get attacked on. But they've also got to put enough out there, both to convince voters, but also to convince businesses, industry, that they've got a plan for growth and a plan for the future of the country. So what I think you're starting to see is the outlines of policy. Mm-hmm. So they've set, for example, fiscal rules. They've set ambitions on climate investment, very much looking over the pond at the US and the Inflation Reduction Act. They've set out the kind of parameters of a policy platform. I think we might see some of the details start to filter through in this conference. But then they're not going to want to tie themselves in knots with policies that risk damage ahead of an expected election next year.
I mean, clearly at the Tory party conference, Rishi Sunak was very worried about inflation and not cutting taxes because inflation is high. Like that is definitely the priority. Like growth is there, but it's about inflation. How does the Labour Party tackle inflation if they're going to outlining growth plans and something to compete with the IRA here in the U.S.? That feels all inflationary.
So I think what you're seeing is certainly fiscal prudence being put ahead of that investment. So I think Rachel Reeves has been absolutely clear that that investment will only happen if it fits within the fiscal rules that she's set, which is about getting debt and borrowing falling. So certainly they're putting that front and center. But I think what you'll also see is that investment going into what's called supply side measures, things that will expand the capacity of the economy on the supply side, which shouldn't in the long run be inflationary, should in fact be deflationary, given that we've got so many supply constraints in our economy. But they're going to be very careful about making sure that they are seen to be economically credible, because we know that historically, one of the things that has prevented the Labour Party winning elections has been the view of the public and of businesses on their economic credibility.
How worried do you think the Labour Party is about the market reaction that they will get? In some ways, we've all learned a lesson from what happened with Liz Truss. What lessons do you think the Labour Party learns from that scenario?
I think the Labour Party have taken the message very strongly that everything needs to be really fiscally credible. There was an intervention a couple of weeks ago where the Labour Party set out plans to really strengthen the remit of the Office for Budget Responsibility, the OBR, which is the kind of fiscal watchdog in the UK. And they were doing that to show that they would take external accountability on their economic plans really seriously. And they were doing that because they know that when the OBR said that Liz Truss's plans weren't credible, the markets took that very seriously. So I think they'll make sure that they are setting out clear plans, that they're creating stability in the financial and fiscal environment, and that they are being held accountable externally to that. But I think we should say really clearly that there is a big difference between an unfunded tax cut, which is what Liz Truss was proposing, and investment in the supply side of the economy in the green transition, which should in the long run be growth inducing. Those are two very different things, and I think the markets get the distinction between the two things.
Right. Sometimes. Sometimes. Maybe it depends on the sector. Hey, Harry, what is Europe going to be watching? How is Europe going to take this? It feels like there have been some movement post-Brexit to establish relationships, right? So what's Europe looking at?
So I think Europe, I think the most important thing here is how big the majority is, if there is a majority. So, I mean, and just to be clear, to get to a majority, even of one, we need a swing bigger than Tony Blair got in 1997 in this country to get a Labour government. So it's a big task for the Labour Party. So that's not at all guaranteed. I think if there's a reasonably big Labour majority, I think Europe will look more positively on the idea that they can do deals with Keir Starmer and the Labour Party on Europe that have some chance of being sustained into the long term. I think if it's a minority government or a very small majority, they'll be very nervous because they will rightly look at it and think, well, we could have a Conservative government or a different government back in power pretty quickly. And at the moment, the Conservatives are still very much anti any moves towards kind of, closer integration. And so there'll be a lot of nerves if there isn't a Labour majority, which is, as I say, the massive task and still seems potentially unlikely, I think.
Yeah, big swing in Scotland, though. That was certainly the takeaway from the by-election, but maybe some one-off factors coming into play there. Harry, great stuff. Thank you very much indeed. That was really useful. Harry Coulter-Pinner, Director of Research and Engagement at IPPR. OK, let's check where European equity markets are finished. Who'd have thought it? There you go. Really positive picture emerging after a day when we've seen a blowout payroll number coming out of the United States. The US labour market is strong and continues to be strong. How does that change the narrative for the UAW? Its President Sean Fain will deliver an update on the union strikes that we're seeing against the big three automakers stateside this afternoon. We're going to have the latest on that story. This is Bloomberg. This is Bloomberg Markets. You're looking live at the principal room. Coming up, Megan Schreiber, Bank of America Director of U.S. Rate Strategy, joining Bloomberg TV, 1 p.m. New York time. This is Bloomberg. So workers at a Chevron LNG facility down in Australia are planning now to resume the strikes that we've seen on, off. That, of course, threatens to disrupt global supplies. This as the Northern Hemisphere approaches its winter season, Alex. This is not a direct effect. This basically kind of ripples through. This is Asian buyers that largely buy from this facility, but it has a global impact because Europe increasingly relies on shipborne gas. It's interesting. You look at what is happening here. Labour certainly feels like it's got more power. You were listening to the Labour Secretary talking to John Ferrer earlier on, mentioning this very fact. You look at the Labour data we've seen. That must give Labour the view that, increase the Labour view that it can act with relative impunity at the moment. The UAW strike, it's going to be interesting to see what happens a little bit later on.
I also am quite interested as to the industries in which this is happening too, and I appreciate I can't paint it with a broad stroke, but you know, take a look at autos and you take a look at energy, and those are two that are under huge transitions, right? For autos going to EVs, and for big energy, it's going to alternative energy in the future. And so how to allocate capital, how to deal with your workforce, I think is quite interesting.
What about the healthcare sector?
Yeah, that has nothing to do with energy transition. That's just pure labor. I said it wasn't a through line. I just said I think it is interesting. And we were talking earlier about the Labour Party conference that you can have growth and you can have, you know, green energy policies, but they do come at interesting costs that it doesn't feel like anyone was expecting.
Yeah, and the sense seems to be that this can go on much longer.
Yeah.
There was a view maybe, and it's been interesting, the UK government in some ways is falling victim to this as well, that there was an expectation that the labour market would soften, inflation would come down, and that would make it easier to negotiate with the unions. But you're certainly not seeing that in the United States.
Nope. Speaking of, UAW President Sean Fain is speaking right now. He's giving some remarks. We're going to see what happens with talks with Ford, GM, and Stellantis. So for more, let's get into this with Bloomberg Detroit Bureau Chief David Welch. Okay, David, I don't see any headlines. He's speaking right now. We're going to keep you updated on the headlines. But what are you expecting from him today?
Look, I think he will expand the strike or at least maintain it at each of the three companies. You recall back the last couple of weeks, he let Ford off the hook initially, and then he let Stellantis off the hook last time he expanded it. GM has not gotten any reprieve from adding plants to the strike. There are big issues at all three companies. With Ford CEO Jim Farley publicly saying that he thought the union was using economic issues and dragging their feet on them to get some sort of framework for workers at future battery plants, that is, workers who haven't been hired or organized by the union yet. GM has been bargaining over cost of living and pensions. They don't want to add too much to their costs with that. And Stellantis has this open plant in Belvidere, Illinois, where they haven't allocated any work, and the union's worried about that. So in addition to the pay and the other things that are being bargained, each one has their own separate issue that is a little different from the other companies. And I think they're going to need to probably make progress on those individual issues to avoid having more plants walk out on them.
David, do you think a strong payroll number, which we're all talking about today, has any impact, any bearing on how this strike is likely to develop? Because the data are telling us that the labour market is still tight and there is still huge demand for jobs.
Okay, I think a tight labour market always gives workers themselves more leverage. This is a case, though, workers in these union jobs, even though they're complaining about pay, they are paid pretty well compared to manufacturing workers in other sectors. So UAW workers aren't getting bad pay. They just don't feel like they've been able to share in the record profits of the companies. But they still would have a difficult time finding that kind of pay if they were to go out and look for other jobs. So, look, it is a tight labor market. I think as we make the transition to electric vehicles and you're hiring workers at battery plants and they make less, it's tougher to keep those workers, so there's going to be pressure on the companies to keep those wages high. GM's already raised wages at its Lordstown, Ohio battery plant by $3 or $4 an hour because they were losing workers. So there is more leverage to the union here, but it's not a make or break thing in this set of negotiations.
We heard from Acting Labor Secretary Julie Sue earlier in the day at Bloomberg Television. She was saying, look, the spread between the companies and the unions is coming down. This is normal. This is kind of what happens. She was speaking at it in sort of like this is a rote process. Is that really true when it comes to what's happening on the ground?
Look, it is getting closer, but there's still existential issues here for the union. And those battery workers, that looms pretty large. These are battery plants the companies plan to build. They've announced, at least 2, 3 of them at each company. GM has 4 of them coming, and I think Ford has an equal number. That's a lot of workers they'll be hiring. Most of those plants are owned by joint ventures with an Asian battery partner, so they're not part of this agreement. And that really irritates the union. They believe that those joint ventures are an end run around the labor contract, and they want to solve that. But legally, they can't bargain on behalf of workers who haven't yet been hired and aren't part of the union. They can get side letters from the companies that set up a framework for how battery workers will be compensated over the next decade. But it's a touchy legal issue. It's a touchy labor issue. Both sides have a strong viewpoint on that. And I think that's one issue that's really going to hold things up here. And pensions is another. The union wants defined pensions back. I don't think they'll get it. I think they will get some nice 401ks. But those are still expensive for the companies if they're going to have a big match or big contributions. So the size of that's another one that's going to be a touchy subject as well.
All right, David, we are watching the headlines. Thanks a lot, David Welch, Bloomberg Detroit Bureau Chief, joining us. And if you want to watch and listen to Sean Payne speak, you can check it out on Live Go. That feed running to you will also bring you those headlines. This is Bloomberg. Stocks are up, something I didn't think I'd be saying to you at noon when we had that blowout jobs number, and yields are still pushing higher. Abigail is tracking the moves for us. Abigail?
Yeah, this is quite a chart, and I wish I had an explanation for it, but you can see into that jobs report basically flatlining and then down sharply on that hot jobs report that sent yields flying higher, as Alex just mentioned. That, of course, puts valuation into question, liquidity out of the system, nerves that maybe the Fed will have to raise again, and that some sort of a recession could come as a result of the consumer slowing down. All kinds of scenarios, but now take a look at this. Up 0.8%. Now, earlier, to be fair, it did feel as though a reversal would be possible, just because it didn't feel like there was so much conviction for the selling. Kind of a brief reprieve, maybe positioning into the weekend. The longer chart suggests that the selling will return, but right now it clearly is not. Now, on the week, though, this is interesting because there is the possibility that we could actually see an up week for the S&P 500. If so, it would be the first up week in 5. The NASDAQ 100 clearly higher on the week, and I think it's actually a second up week for the NASDAQ, or the NASDAQ has been doing better than the S&P 500. And then here are those yields Alex was talking about. I mean, this is incredible. On the week, the 10-year yield up 20 basis points at a 476. The 2-year yield still above 5. When will this selling in bonds abate? Well, it might not be anytime soon. If we take a look at CFTC short positioning on the part of speculators, but we're just thinking about the trends. So this is back in the global financial crisis, way long as folks are really seeking safety. This is in that 2018 sell-off. This is pretty interesting, actually, because a lot of this had to do with when Fed Chair Jay Powell made his first pivot from hiking to then pivoting, and then this bond short came off. Well, right now we are clearly at a record short, and I would make the case that it's going to take a while for it to come off, Guy. But this is a great chart, a way to figure out when, in fact, we may actually see yields back off. But I think right now it's not saying anytime all that soon.
Absolutely. And we're all now anticipating what's going to happen next week with the CPI number. How could that change things? Could it exacerbate the move that we've seen thus far? Abigail, thank you very much indeed. Wow, what a week we have seen. What else are we still watching? Amazon apparently going to launch prototype satellites today on a very big rocket for 2 relatively small satellites. They're kind of keen to make sure these things get into space. President Biden meeting with the space. What did I say?
No, just space. I'm saying space.
Oh, space. Oh, yeah, sorry, space. Space is important. Yep.
Keep going.
Alex knows all about space.
Keep going.
She did a whole special on space.
I actually did.
The German president, Frank-Walter Steinmeier, is going to be meeting the president. And Alex, I assume you have a ticket. How big's the Powerball now?
It is.
I am fascinated by this.
Okay. What about? Oh, okay, it's 1.4 billion.
You guys pay tax on. You guys pay tax on that, and that number's not real, is it? If you want the money, you don't get the 1.4 billion.
No, it's not. It's not real. Like the lump sum, I think the cash value is like 643 million or something like that. But I mean, I'll take it, no problem. I don't buy a lot of tickets, but my husband has like a threshold for like when it hits a certain amount, he like goes all in. He has his own system, so you know. Maybe I'll see you Monday. Maybe I won't.
Okay. But you have to pay tax on it. If you win, you have to pay. Over here, no tax. No tax.
How is that possible?
If you win the lottery, the numbers are smaller, but there's no tax. It's yeah.
Okay, so what does it get to? Like, what's the biggest one it's ever been?
You can get over 100 million. And that's a euro million, sort of north of 100 million, 120, 130 million. You get those. It doesn't tend to go much further. But I think the billion number associated with the Powerball is misleading because you have to take that over a number of years, don't you?
You can do either. You can do the lump sum, or you can take it, pay out every year. A lot of people wind up taking the lump sum. I just can't get over like no taxes, like anything. We love the taxing here. That's crazy. Anyway. Which is ironic because everybody thinks about you as a low tax environment, but maybe not so much. I don't know. Maybe this is me talking my own book. Okay, well maybe if I win the Powerball, I won't see you Monday. Joey Mack, Chicago Blend CEO, joins Bloomberg Tech. This is Bloomberg.